Buying a home is the dream of many people, but rising interest rates and elevated home prices have made achieving this goal challenging. The average rate on a typical 30-year, fixed-rate mortgage has been zigzagging between 6% and 7% for the last several months. This is down from above 7% in early November but roughly double the 3.3% average rate heading into 2022, according to Mortgage News Daily. The interest rate that a buyer can qualify for depends at least partly on their credit score. This means that you have some control over whether you're able to get the best available rate. The difference that a good or excellent score makes in terms of monthly payments and total interest paid while holding the mortgage can be significant. So it's worth making sure you go into the process with as high a credit score as possible. Your credit score feeds into a lender's calculation of how risky a borrower you may be. The three-digit number ranges from 300 to 850. If you've always made your debt payments on time and you have a low credit utilization, how much you owe relative to your available credit, your score will benefit. And the higher the number, the less of a risk you are to lenders, and therefore, the better terms you can get on a loan. Lenders check a homebuyer's credit report and score at each of the three large credit reporting firms: Equifax, Experian, and TransUnion. For mortgages, the score provided by those companies is typically a specific one developed by FICO, which is the score currently relied on by Fannie Mae and Freddie Mac, the largest purchasers of home mortgages on the secondary market. In the coming years, this reliance on one score is poised to change. However, because that particular FICO score can differ among the three credit reporting firms due to differences in what is reported to them and the timing, mortgage lenders use the middle number to inform their decision. The higher your score, the lower the interest rate you'll be charged. For instance, on a $300,000 fixed-rate 30-year mortgage, the average rate is 6.41% as of Thursday, if your credit score is in the 760 to 850 range, according to FICO. This would make your monthly principal and interest payment $1,878. On top of this amount typically would be property taxes, homeowner's insurance, and, if your down payment is less than 20% of the home's sale price, private mortgage insurance. On the other hand, if your score were to fall between 620 and 639, the average rate available is 7.99%, which would mean a payment of $2,201, again, for principal and interest only. Because of how loans are structured, most of your monthly payment would go to interest at the beginning of the loan instead of toward the principal. If you want to get your score up before applying for a mortgage, there are some key things you can do. Firstly, pay your bills on time, keep your debts low, and show that you can successfully manage a variety of types of credit over the long haul. Secondly, lower your credit utilization ratio, which refers to credit card balances. This resets every month and typically reflects statement balances, so you should aim to keep it as low as possible. Finally, avoid opening too many new accounts at once. This can look risky to lenders and negatively affect your score. Other strategies for improving your credit score include correcting errors on your credit report, using credit responsibly, and avoiding opening too many new credit accounts at once. Correcting errors on your credit report is an essential step in improving your credit score. You can request a free copy of your credit report from each of the three credit reporting bureaus once per year at annualcreditreport.com. Review your reports carefully for any errors, such as incorrect personal information, inaccurate account information, or fraudulent activity. If you find an error, dispute it with the credit bureau and provide any necessary documentation to support your claim. Using credit responsibly is also crucial for improving your credit score. This means making all of your debt payments on time, every time, and not using too much of your available credit. Lenders like to see that you can handle credit responsibly and won't be a high risk to them if they lend you money. Finally, it's important to avoid opening too many new credit accounts at once. When you apply for new credit, lenders will perform a hard inquiry on your credit report, which can lower your score slightly. If you open too many new accounts at once, it can signal to lenders that you are desperate for credit and may be a higher risk borrower. Overall, improving your credit score takes time and effort, but it can pay off in the long run when you're able to secure better terms on your mortgage and other loans. Consider a credit counselor if you're struggling to improve your credit score on your own. It may be worth considering working with a credit counselor. A credit counselor can help you develop a personalized plan for improving your credit, provide financial education and budgeting assistance, and even negotiate with lenders on your behalf. Be sure to choose a reputable credit counseling agency, and check to make sure they are accredited by the National Foundation for Credit Counseling or the Financial Counseling Association of America. Avoid any credit counseling services that charge high fees or promise to erase your debt in a short amount of time, as these are likely scams. Save up for a larger down payment. Another way to improve your chances of getting a better interest rate on your mortgage is to save up for a larger down payment. The more money you can put down up front, the less you will need to borrow, which can make you a less risky borrower in the eyes of lenders. Most lenders require a down payment of at least 3% to 5% of the home's purchase price. However, if you can afford to put down 20% or more, you may be able to avoid paying private mortgage insurance, PMI, which can add several $100s to your monthly mortgage payment. In addition, a larger down payment can help you qualify for a lower interest rate, as lenders may be more willing to offer better terms to borrowers who have more skin in the game. Consider alternative loan options. If you're struggling to qualify for a traditional mortgage, there are alternative loan options available that may be worth considering. For example, FHA loans are backed by the Federal Housing Administration and require a minimum credit score of just 580, although lenders may require a higher score. These loans also require a lower down payment of just 3.5%, making them an attractive option for first-time homebuyers. VA loans are another option for eligible veterans, active duty service members, and surviving spouses. These loans are backed by the Department of Veterans Affairs and offer competitive interest rates and low or no down payment requirements. USDA loans are available for low to moderate income borrowers in rural areas. These loans are backed by the U.S. Department of Agriculture and require no down payment. While these alternative loan options may come with different requirements and restrictions, they can be a good way to get into homeownership if you're having trouble qualifying for a traditional mortgage. Well, that's all for today's discussion on building wealth. I hope you found the information useful and informative. Remember, achieving financial freedom is a journey that requires discipline, hard work, and patience. But with the right mindset, tools, and strategies, it's absolutely achievable. If you want to continue learning about wealth building and personal finance, be sure to subscribe to Wealth Builders. Our channel is dedicated to providing valuable insights, build wealth, and create the life you want. So what are you waiting for? Hit that subscribe button.